So hi everybody and welcome to our panel. Over the next 30 minutes we're going to discuss all things InsurTech, and we're going to explore where the real opportunities in that space are. I'm Paul Morgenthaler. I'm a partner with Commerz Ventures. We are the venture capital fund of Commerzbank, investing in fintech and insurtech companies across Europe, the United States, and Israel. And I'm very happy to present you a trio from the UK today. They flew in all the way from London. They are InsurTech veterans, and we're really happy to have them here today. And we'll ask them quickly to introduce themselves. Okay, if you start.
Hi. Hi, everyone. My name's Oki Lazu. I'm Chief Operating Officer at Bought by Many. We're an InsurTech. I've been going 6 or 7 years, but for the last 3 years we've been selling our own products, so as an MGA, in the pet insurance market.
Hey, I'm Sammy Rubin. I'm the founder and CEO of ULife. We're a new life insurance company that inspires life. We don't talk about death too much, but we inspire people to live longer, happier, healthier lives. We started 3 years ago. We launched about 9 months ago. We're selling insurance to companies, life insurance to companies. They cover their employees, and then they get a reward, an app where they can get healthy rewards, incentives and rewards for doing healthy activities.
And I'm Rob. I'm one of the partners at Balderton Capital, so I'm the other investor in the room. Some research recently showed that we're the most active Series A tech investor in Europe at the moment. We invest across Europe, but we invest at Series A. We invest across sectors. I personally do a lot of fintech and insurance. So in insurance, I was the first Series A investor in Zego. We provide insurance initially for the gig economy, and now insurance for all forms of new mobility. They launched in Spain fairly recently, originally from the UK. Made another investment in a company called Dingy, and in fintech companies like WageStream and Clio. And then in our portfolio more broadly, we're investors in Revolut, Go Cardless, Comply Advantage, and similar businesses.
Great, let's get started. So insurance hasn't really experienced that much disruption as many other sectors. Okay, why do you think that is?
Yeah, I think insurance is a tough gig. Theoretically, it should be right for insurance is 300 years old, at least 300 years old. And having worked in the big insurers, one of the biggest, two of the biggest, Prudential and Legal & General in the UK, it's one of those that hasn't actually moved on that much. But the reality is the barriers to entry for a new entrant are significant in the insurance industry. The first one of those is really access to insurance capital. So you can't just start an insurance company. And that's difficult. You have to go and find someone who's going to work with you to do creative things, launch innovative products, and take a bit of risk in doing that. And that's not easy. So I think that there's a barrier in terms of that. I think also there's barriers in terms of distribution. Distribution in insurance kind of goes in waves. It's a very difficult thing to break into. So if you're going to sell insurance direct, you find yourself a capital provider, but then you've got to be able to economically sell products, and that's really, really difficult unless you find a vehicle to do that. The one most recently are comparison websites, but that becomes a price game. So distribution is one of the hardest things to crack, not just for us InsurTechs, all InsurTechs that start. And I think probably the last thing I'd mention is around giving it a go. So, for example, I've just listened to N26 in the room over there, and you talk about Monzo. It's pretty easy to get a credit card and become a customer. It's pretty easy to open an account. You know, it doesn't cost you anything, so you can grow really quickly into vast numbers. But with insurance, even life general insurance called general insurance, that's a 1-year contract. Having a punt or something you love for a 1-year contract or subscription, as some people call it, is much, much tougher decision to make. So growing quickly can be much more difficult. So I think all of these things add up to why, although disruption insurance sounds eminently sensible, it's a really, really difficult thing to do.
So now we have heard about all the barriers to enter that space. Sammy, why have you then entered that space? Is it actually attractive for a tech-driven startup to do insurance?
Yeah, I'm a little bit of a masochist, maybe, but I like pain. However, bearing in mind all the obstacles, I think the life insurance, or insurance just generally, as you were saying, is a huge industry. I mean, just in terms of the sheer size in the global industry, it's huge. And obviously, a lot of the disruption has happened in areas which people desire, which people want. Insurance isn't something that you wake up in the morning and you think, oh, I really want to buy insurance today. It's something you need, but it's not something that you want. And one of our challenges is to somehow create a proposition that is engaging, that people want. So for me personally, I was really attracted by the sheer size of the opportunity and also the fact that there really is lack of innovation. It's an open canvas, and there's a real opportunity to really shape it. It's not sexy, and I actually like that. I've worked myself in 2 other startups in the life insurance space. I've always been drawn to life insurance and working with actuaries for some reason. I find them engaging, exciting, inspiring. I don't know why, but I do. The complexity of the operational insurance infrastructure, it is complex, it's challenging. It's hugely sort of fulfilling in terms of the number of things and obstacles you have to navigate. So I'm really excited. I'm really happy that we've launched a new life insurance company in this space. Life insurance tradition has been the last thing that has really been disrupted in the insurance game. And I really am excited that we hope to be one of the new players in that space.
So when 5 years ago, we were starting to invest from our first fund and we were looking for startups in the insurance space, basically there was none. And meanwhile, of course, that has drastically changed. And just over the last weeks, we have seen some astonishing mega funding rounds of InsurTechs. So I'm asking the investor on the panel, Rob, what should we make of these mega funding rounds? Is there signal or is this just noise?
I think funding rounds should always only be, at best, a distant signal of what's really going on. And what really matters is, are people building real businesses? Are they building real premiums? Have they got sensible loss ratios? Are they delivering a great customer experience? And that's what we should really care about. And yeah, like you, I started looking at InsurTech probably 4 or 5 years ago. Went to the first InsurTech Connect conference in Las Vegas, met the founders of Lemonade and Trove and Hippo, and thought, okay, this is really exciting, let's go. I'm going to make like 10 investments in this area over the next few years. And I've made one and a small one. And yet, so it is good to see the money there. And I think what's good is that lots of VCs are interested. SoftBank, obviously super interested, put a lot of money into Lemonade. I think they'd love to do more as well. And then the strategics are also very interested. So there is plenty of money there. I think it's probably more is being invested earlier on into companies than you might see in other sectors, and that can be dangerous. So I think that's something we have to watch as investors, that we're not giving companies too much money too early that ends up sort of putting on the wrong path.
Let's stay a little bit with Europe. You've seen probably hundreds of InsurTechs over the last few years, and drawing from that and recognizing the patterns. What do you think are the most attractive vectors of attack for an InsurTech startup?
So I think there's a lot to go up against, as OK mentioned, and there's huge data and historic data. There is network effect with brokers, there's network effects in distribution, there is all the claims history that existing insurers have. So I like companies that can go in and either work with existing insurers, so like software, B2B plays, or they find new segments or new categories where there is no history. So one of the reasons we invested in Zego is they started off doing insurance for Deliveroo drivers and Uber drivers, which is a new category. And existing insurers had no historic claims to go with. They had no way to price that risk. What they do is that means they just triple the prices and think they'll work itself out, and that creates an opportunity for a hungry startup. Similarly, you see companies doing drone insurance or doing cyber insurance or taking new categories that existing insurers can't get their heads around. On the B2B side, we see people taking new data approaches. So most actuaries are very smart people working in Excel doing linear regressions. If you can take a machine learning approach driven by 2019 technology with 2019 quality software engineers, you can really change that. So I think that's what we're seeing more on the B2B side. It's those machine learning driven companies making headway.
And what is the right model for distribution? I mean, if you start out as an InsurTech, you can go B2C, you can go B2B, or then there are companies that are going B2B2C. Sammy, what's your view on that, and how have you gone about that decision?
I think there are different modes of distribution for different types of insurance. So different categories lend itself to different types of distribution. In terms of our own experience, we actually set out on a B2C journey. And we were very excited about just going at the public. And it's actually through raising money, and I think it was maybe conversations like with you, Rob, and with other investors. And we were very fortunate. We were funded by Local Globe in our seed round. And Local Globe were really, really good at sitting us down and pointing out some of the real challenges of B2C. I mean, I know that you're doing a terrific job in the B2C job, but in terms of building a new life insurance brand that really engages people and gets people to want to buy life insurance, that's a really big ask. So we pivoted, or we expanded our model to a B2B model. And since then, things have really opened up for us. We're very excited about B2B because businesses in general in the UK and in many countries around the world, they do buy life insurance for all their staff. And it's just seen as a tick box. So it comes by yearly, annual renewals. They just buy their life insurance, and often it may take a few days or a couple of weeks to get a quote, and they're just used to a very old, automated, old way of actually buying their life insurance. But it is an existing market that's already in play, and it hasn't been disrupted. So for us, that was an opportunity for us that was really exciting. So we go into companies, and we're not just selling life insurance, we're selling wellness. And going back to what I said earlier, it's, in terms of insurance, something that you need, wellness is something that people really want. So we've created a currency of well-being, for example, because Ucoin, for every mile you walk, you earn a Ucoin, and you can exchange that for air miles. So you can walk a mile, earn an air mile, or meditate and earn Amazon vouchers. You can offer that to your staff, and that's a real compelling proposition for a company. So beyond the life insurance, we're actually expanding it into a wellness story or a wellness product. And that's something that's sort of opened, that's really accelerated our growth. So I think there are different distribution models. We've gone for the B2B. There's also the B2B2C in that consumers or employees themselves can top up or upgrade their life insurance directly through us as well. So one has to be careful. But I think the B2B is really where the real opportunities are. But if one can crack it in B2C, then like Lemonade, bought by many, I mean, I think that's really the huge potential.
Yeah, I mean, okay, your company, bought by many, is seen as one of the few successful examples of a B2C InsurTech. In brackets, we're an investor, so I have to disclose that. But it's true. I mean, B2C for you guys has worked really well. Was there once a point when you thought, well, maybe we should switch to B2B, or was it always very clear for you that B2C is the path for you? And how did you go about that?
Yeah, no, good question. I think whenever people talk to me about InsurTech, and we often talk about these different distribution models, I can see why many start down in the B2C and go into B2B. There are difficulties in B2B as well. The length of the sales process is also quite challenging. But I mean, I joined almost 4 years ago, and the reason I joined was because I could see what the guys had done in terms of understanding how to reach out to customers using digital channels. We are a business born in the digital age. So Google and Facebook and Instagram are things that are just natural to us and our team and our marketing and distribution team. And actually, when I realized that, I thought, well, if these guys can really crack how we can reach out to a group of people and get them engaged, what we have to then do is build I know, make it sound that easy, is to build products that get product market fit, that customers will believe in, and then also build an operation that will deliver excellence in customer experience. So, because the reality is, insurance is a trust game. People generally don't trust insurers. So if you can build a business that they do trust and they will recommend, then actually you get this whole, if not viral effect, but this whole member get member situation going on. And that's effectively what's happened. We've been able to start by using a reasonable amount of money to reach people in volume. We've created products that meet their needs and show them that we care, right? Importantly, show them that we care and they can trust us. So even though pet insurance is a bigger market, we produce products that really met the pain points of customers. And even if customers didn't buy those products, they thought, well, these guys have thought about it. They care about the things that are difficult for customers in this area, which meant they gave us a chance. So we became a brand builder in what is a notoriously difficult thing to do. And then in terms of delivering service, Paul, you know all about it, but we have a Net Promoter Score that vacillates between 75 and 80. 75 and 80 across all touch points for an insurer, which is frankly ridiculous. And it's done because we've worked really hard at like all InsurTechs do actually, but understanding customers, what they need, how we can deliver a service that meets their need and can be 10 times better than the incumbents. And I kind of talk about it. It's a bit like if you're a surfer. You try and get through the first waves that are difficult, but if you can make it, just the same way you're saying, if you can make it over those waves in a B2C market, then suddenly it's calm. And the next big waves will be the competitors coming at you. But you've just got that opportunity to build a brand that people trust and recommend. As I say, 20% of our customers come from recommendation from other customers. And that's been the same whether we were growing at 10% or growing at nearly 200%, which is what we're doing at the moment.
And the great advantage you have is people claim quite a lot on pet insurance, and you have a fantastic claims experience. So I'm not an investor, so I can say those things.
He definitely is.
So you can delight them with the claims experience, and then they can start telling their friends. I think other insurance categories like life, it's harder because people don't claim very often. So it's
Rob, you've hit the nail right on the head. We invested. When we sat down and looked at the claims, we sort of said claims will be the thing we win on, right? Yeah. And so right from day one, we said we will have no claim forms, right? This is a modern business. Why are there forms in this? And so people can take a picture, upload it, and there they start. And actually, if you read our FIFO reviews, people always talk about that. And you're absolutely right. 1 in 3 people, customers claim, which is much higher than motor, much higher than home. Yeah. But they experience this incredible claims process, which frankly sometimes they don't believe how quick and easy it is, and they tell other people about it. And I think the other thing I'll add, sorry to go on, is that pet insurance is an emotional thing. We insure something that people think as next to their children, a really key part of their family. So when you get that right, and people are in an emotional state, they like you. Our vision is to build an insurer that people love, and we're a long way along in doing that.
So over the recent months, there has been a lot of discussion around neobanks versus neo-insurers and which model is the more attractive bet for investors. So with Rob, we have an investor in a neobank, so I think you have a privileged vantage point on that question. Where do you weigh in that discussion?
I think, comparing neobanks to neo-insurers is tough. I think, so what I like about Revolut and also about Clio, which you might not know, but is a sort of even thinner sort of layer around controlling your finances. I like both of those is that people really engage very strongly with them. This is where your money lives. This is where financial services lives for you. You're using your Revolut card a lot. You're doing foreign exchange through Revolut. That gives you that day-to-day contact with a customer. And that allows you to cross-sell a whole bunch of different products, whether it's trading of stocks, it's investments, it's loans, it's foreign exchange, it's crypto, or it's insurance. And Revolut actually sell 2 different insurance products quite successfully already. And I'm sure they'll sell more insurance over time. So I think that's the advantage they have. They have that regularity of touch point that I think it's no insurance business can ever generate. What we saw in Germany a few years ago was a bunch of companies like WeFox, Knip, Clark, GetSafe, all trying to be this kind of insurance wallet, a bit like a sort of Revolut of insurance. And they've all sort of iterated and developed on that model, and a couple of them have got their own insurance license and started selling their own insurance. Because I think it's really tough to be the insurance wallet. What you can do is insurance is absolutely $1 trillion industry with great margins if you do it right. And so there's a very profitable model to be had there if you can really make it click.
Can I take issue with that?
Yeah.
I agree with everything you said, and one of the things and challenges that we've worked on is this touch point and this idea of engagement. That's because on average, a life insurance company may have 1 touch point a year with their customers, maybe 2 if they're lucky.
Yeah, that's where your wellness comes in.
Exactly. Yeah. So I mean, just in terms of the model that we've done and other insurance companies are doing, we've built sort of a gamified model where people are downloading the app and using it up and engaging with YouLife. Our average touch point is about 120 times a year now. So our DAU over MAU, our daily active users, is like 40%. So 40% of our monthly users are engaging every single day with YouLife. They're checking their Ucoin, they're checking their wellness, they're checking their steps, they're checking their mindfulness. And obviously, they can upgrade their life insurance within the app as well. So you're right, it sets a challenge for insurance companies. How can we engage more? You look at a company like Discovery or Vitality. I was the founding CEO of Vitality Life in the UK, but you look at now how much that insurance company in South Africa, how many, so they're doing car insurance, they're doing life insurance, they're doing health insurance, they've just started a bank now. They're doing savings, they're doing investments. So I do believe if you get the engagement right, and we're doing that around wellness and gamification, I think the opportunity to expand into other products, I think, is enormous.
If you bring together the engagement of a neobank with the monetization of a neo-insurer, then obviously you have the big winner.
Yeah, that's a good challenge for us.
Well, I agree, and I think there's a whole thing around ecosystems, and I think that's what you're talking about. All insurers have to think ecosystem now, not just insurance. How can I engage in other ways with the whole ecosystem? Same for us with pets. So we've looked at, dog walkers and device wearers, and what can we do? Can we work with banks, neobanks, and otherwise? The whole thing, I think I was in a session around collaboration. I think if you're going to be a smart startup, what you've got to think about is not just what you use in your core, but how you can grow the core by attaching to the ecosystem. And that's a real advantage for InsurTech because they normally have new systems which can link in with partners much, much quicker than the incumbents can, who are stymied by legacy systems that make it very difficult for them just to take an idea, run with it, get up and running in weeks and months. And so I think that's another area where InsurTechs have a real advantage.
So the success of an InsurTech obviously depends on the right strategy, the right entry point in the market, but also on the thousands of operational decisions that you have to make and the execution. And I would like to ask the 2 founders, what do you think are the key success factors for an InsurTech from an operational point of view?
So we're looking at various factors. We're obviously, from our perspective, we're looking at the number of companies that we engage with. So we're looking at the number of companies, the size of those companies. We've now over 100 businesses are now coming to us because at the moment in the UK, you've got 50,000 businesses that have life insurance out of 1 million companies that actually don't have life insurance. So even of those 50,000, and some of those are very sizable, there's a big market there, and obviously at the moment about 60% of our companies have never had life insurance before. So we're getting those companies that are switching life insurance to us, and those who are buying life insurance for the first time. That's, for us, we're always looking at the type of the ideal customer profile, the customer who's buying our life insurance. we're looking at the engagement, because we know that if we can get employees to engage on our app, that creates a very sticky experience. If a company, so we're dealing with a company, for example, now Mintel, 500 staff, has just taken ULife for all their staff. They've now got leaderboards, they're comparing how much Ucoin they've earned, they're competing with one another on their steps, they're looking at how much Amazon vouchers they can buy with their Ucoin. There's a competitive spirit, and we go in with smoothie bikes, we do wellness days. It's very hard, if a company's really engaged, for them to switch to a traditional life insurance at the end of the year. That's something which we feel we're very optimistic about in terms of that stickiness. So we're always looking at, obviously, our own margins, and we're looking at the number of companies that we're working with and the type of company, and then we're looking, crucially for us, is our engagement stats and how much are the employees engaging in our app.
From our perspective, I've kind of mentioned it, we're a business that built with the customer at its core. Literally obsessive, customer-centric culture. That's what we're about. And so, right from day one, when we had 0 customers to now where we're approaching 100,000, we've always monitored our net promoter score. It's kind of like your engagement thing. This is the thing across touch points that tells us we're doing a great job for customers. We look at being I suppose two real key pillars. Ease and ease to deal with, and showing that we care. And we know we're pretty sure that if we can keep those metrics high, the rest of the business will fit in behind us. So the technology. So we are a tech business, right? But the tech is there to support being great for customers, not for the sake of it. Whether that's our own tech or third-party tech that we bring in because it helps us. For example, we just do some work with an AI-based feedback business called Chattermill, and that's been incredible for us to analyse all our Zendesk tickets and tells us a completely different picture to our traditional feedback mechanisms of what we're doing well and what we're not doing well for customers, which means that we're able to really, really clearly go and fix stuff within the tech or within the service proposition or within the type of people we're recruiting or within the way that live chat works, all of these things to make things better for customers. And we just measure it. And so, I think often when I talk to people, whether they're investors, and they say, surely there's more to it than that. And I say, there isn't, right? The customer is at the center of what we do. Everything we do as a business is focused on making them happy. And them being happy means that it was easy for them and they thought that we cared about what they did. And that simple model seems to work.
Great. We have 20 seconds left for this panel. And thank you very much to our panelists. And you managed to do one thing that's becoming increasingly rare these days. Very few of you guys were staring at your phone during the panel. So to me, that is like the KPI to measure the quality. I think you guys have done well. Thanks a lot.
Thank you.